But thanks for taking the time. I'm going to start today in an unusual spot, I suppose, in that although this is a Q1, review as we head into Q2 here, I'm actually going to start with some current events, kind of address the elephant in the room, if you will, that has started off our second quarter. And, I normally, when I'm preparing for these, I start doing like an outline 3 weeks ahead of time. And so the last week of March, I started working on this, and I thought it'd be apropos. Like April 15th was the first session that we did, and that's tax day. And so I'll build out kind of the talk around taxes. And over the last couple of weeks, boy, have we been talking a lot about taxes, but taxes by a different name. We've been using this word tariffs. And so I suppose my outline got scrapped, but the topic is still roughly the same, although a little different perspective. And again, if you've joined me before, you kind of know the cadence of this meeting. I usually start with the market and a Q1 review. What do we see coming in the second quarter and then into the rest of the year? The economic data and a little bit of an economic outlook. And then I'll finish the last 15 or 20 minutes with some specific topic, usually investment related, although sometimes it's a financial planning topic. And that will be the same today. I will do all of that, but if you'll permit me, I'm going to start a little differently. We're going to start with a conversation around what's happening here in Q2 and a little bit of our perspective on that. And then we'll launch into, what happened in Q1. So for those, and you don't need me to read the screen. You guys can all read. And for those who know the poem from Kipling here, you will recognize I have taken, great artistic license to paraphrase it to sort of make my point. But the idea here being, keeping your wits about you when those around you are losing theirs. And by the way, I should start with, because I shouldn't always just assume that everybody knows what I'm talking about. If you've been out of the country, or television hasn't been working, or your phone was at the bottom of a well, 2 weeks ago yesterday, the current administration announced a new tariff package, a new tariff program that threw the at least domestic stock market into a bit of a tizzy, we'll say. The market slid about 10% over 3 days. We haven't seen that in about 5 years since the economic shutdown during the pandemic, and that didn't feel so good. That was immediately followed by a 90-day pause of those, or at least the vast majority of those tariffs, and the market, by and large, then recovered over about the balance of last week. So a very sharp decline in recovery in a short period of time, all around the emotions that go into tariffs. So with that, some perspective, and I hope that that's the vein that you will hear these comments in. It's all around perspective, because, and I mean this sincerely, in no way do I want to rob anyone of their opportunity to feel how they feel about this. If you're angry, if you're anxious, if you're scared, if you're elated or happy, if you think this is a positive thing, I don't want to steal any of that from you. I really don't. You have every right to feel that way, truly. What I hope to provide is a little bit of perspective so that you don't let however you feel, frankly, at any time, but certainly now, to color your investment decisions, your investment policy. We don't want to allow our emotions to dictate our decision making. And so that's where that's the spirit in which this is being delivered. First and foremost, if you've gone through the financial planning process with our firm or any other firm, I want you to refer back to that financial plan, because I can assure you, if that plan was in very good shape 3 weeks ago, it's in very good shape today. And by the way, it was in very good shape 10 days ago. If your probability of success was, I'll make it up, 92%, 6 months ago, it's still 92% today. Your plan is built for this. When we build out a financial plan, we know with certainty that there's going to be uncertainty, and we factor that in to the long-term trajectory of that plan. We know that this stuff is going to happen. We don't know when, we don't know why, we don't know what, but we know that it will. We know that it will happen. And because we know that it will happen, we factor that into your plan. And so when we come to you and tell you you have a 92% probability of success, we mean it. We have factored this stuff in. And so it has had no impact these last couple of weeks on the big picture. Your ability to pay for kids to go to college, or grandkids to go to college, or retire on time, or maintain your lifestyle through retirement, travel the way that you want to travel, whatever it is that you've saved the money for, it's every bit as likely today as it was 2 weeks ago. Your plan has accounted for it. And I want you to have confidence in that. Truly. We built your plan around the volatility. We built your plan factoring uncertainty. So with that, my second point is that what we're experiencing now is a little different than what we last experienced in the last market downturn, which was 2022. When what we're seeing right now, although very, very emotional, unlike 2022, there is a portion of most portfolios that is acting the way it's supposed to act. And that is the bond portion of your portfolio. Unlike 2022, when bonds did not act like bonds because of what was happening with interest rates. This year, bonds are acting like bonds. Yes, we had a couple of days that were a little scary there. The bond market kind of froze up because of all the uncertainty around what was going to happen with tariffs. So we had kind of a 24-hour lockup of the bond market. By the way, that's not all that uncommon. That does happen. We saw it a little bit in 2022. We saw it a couple times in 2020. Actually lasted a little longer in 2020. So it's not all that uncommon. But bonds as an asset class are acting the way bonds are supposed to act right now, and they are buffering the volatility in the portfolio. And my point in that is when you turn on the news and you hear all the scary numbers, 2 weeks ago, one of the favorite lines that was being reported was that the market lost $50 trillion in just 2 days, as though it had evaporated into the ether. Not at all the case, but when the market was declining and it was down about 10%, which for the year put it down about 15%, most moderate portfolios, kind of middle of the road, 60% stocks, 40% bonds, 65-35, somewhere in that area, those portfolios were only down 5 to 7%, so less than half of what we were seeing in the stock market. And that is the role that bonds play in our portfolio, to mitigate some of that volatility. Now, some of us have more aggressive portfolios, and those portfolios were obviously more adversely impacted. But for those moderate portfolios, that diversification is working. And by the way, it's not just working in bonds, it's also working in international stocks right now. So even though the scary news wants you to freak out, that's how they get your attention and get to attract more ad revenue. Even though that scary news wants your attention, the reality is, for most of us, we weren't experiencing what the scary news was imparting. We really were probably less than half. And to further that point, for most of us, we haven't even seen a negative statement yet, because again, a good middle of the road portfolio through the end of through the end of March, I'm sorry. Even though the market was down through the first quarter, most moderate portfolios were up about 1%, which is no great shakes, but it's not negative. And we're not to the end of April yet. So for most of us, we haven't even opened up, despite all of the anxiety and the news and the worry. And, we still haven't yet experienced a month where our account balances are down. And so, we don't want the scary news to I don't know, have an impact. I talked 90 days ago during this session. I talked about putting on our suit of armor, right? Building up our suit of armor stronger and stronger, so that when the arrows of uncertainty are flung at us, we can deflect them without even noticing. And right now there are a lot of arrows of uncertainty being flung at us, and that's okay, as long as our suit of armor is ready. And so let's make sure that our suit of armor is on. We expected this type of volatility. We talked 90 days ago about why we thought there was a high likelihood for volatility around tariffs. And it's all emotional. Tariffs, if you'll remember, tariffs aren't even the thing we were worried about at the beginning of the year. At the beginning of the year, we were most concerned about inflation and interest rates. And thankfully, some of that worry is subsiding and that inflation has been improving. But still, for this year, we think there's more volatility ahead, not so much because of tariffs, but because of interest rates and the moves that the Federal Reserve will make around inflation, et cetera. Although there is some really good news there. And I'll get there in a few minutes. So none of this is to suggest in any way that we're excited about the potential for more tariffs. We are not. Tariffs generally are a bad thing. And I'm going to do a little tariff history lesson as we get through this to talk about that. Tariffs are generally not healthy. That doesn't mean they can't be useful tools. It doesn't mean that the economy can't absorb some tariffs, but broad-based tariffs generally backfire, and we'll talk about that. So we're not fans of tariffs, but we can't control any of that anyway. So all we can do is control how we react to it, and not allow our emotions to get the better of us and make investment decisions from those emotions. So two last points. One, fundamentally, the economy is still very good. The economy is still very strong. All of the economic data I'm going to share with you today is going to be positive. There really isn't any significantly negative economic data right now. So the economy continues to be strong. And if there's any silver lining, and I'll grant you, this is a little bit of a stretch. I'm kind of reaching for the silver lining. But if there's any silver lining right now, it's that equities or stocks are far more fairly priced than they have been really in the last 2 years. I've been talking a lot over the last couple of quarters about, really over the last 2 years, about how expensive stocks have gotten, how high PE ratios are, and that we would like to see, hopefully, earnings data catch up to prices to bring PE ratios down. Unfortunately, earnings has been strong. That's the good news. But now prices have come down, and that's making our PE ratios a little bit better. But for the first time in a couple of years, stocks are, I'll say, fairly, but they're not cheap. Stocks are not cheap right now. They're not on sale necessarily, but they are more fairly priced. So as we're adding money into our 401ks, 403bs, retirement plans, even as you're rebalancing your portfolio and buying back into the great stocks that you own, you're taking advantage of better pricing right now than we've been able to take advantage over the last couple of years. So really some positives there. And I know I'm stretching a little bit, but we've seen some good moves in that direction. So please do what you can to ignore the weather, and ignore the news, enjoy the weather, and recognize as best you can that this too shall pass. And so much of what we're hearing right now is emotional investors trading because of uncertainty, and we're just not going to get caught up in that. So, all right, let's talk about the last quarter and even a little bit over the last year. So, quarterly data, which is also year-to-date data through the end of March, was not great. I won't pretend that it was. S&P was down 4.5%. Dow about 1.25. Mid cap and small cap got banged up pretty good. Almost all of that happened in March. January and February are actually pretty good. March, we started to see the market turn, and I will note there that not all of what we're seeing right now is tariff related. There's no tariff announcement until April, and yet March was not a great month. And there were a couple reasons for that. Some of it was still talk about the debt ceiling, but a lot of it was talk about interest rates. And frankly, we are due for some type of market correction. Whether that happens this year, next year, I don't know, but we think it's likely to happen this year, probably over the summer, to get prices back in line with earnings. That again, going into the year, has been our bigger concern. And we think, to see some of that in March. Now, it certainly got accelerated as we got into April, but the market was already teetering a bit through the month of March. And so we did not have a great first quarter. Now, year over year, we're still doing pretty well. And by the way, bonds are up about 3% for the year. International stocks are up about 1% for the year. So portions of the portfolio are doing okay this year, which is why through the first quarter, broad-based diversified portfolios, especially in the kind of middle of the road moderate portfolios, did okay. And year over year, they're doing okay. Stocks are still up for the year, and bonds and international are up for the year. I'm going to actually start making a note to include some of those numbers down here for our next session. But really, not a bit of a rough quarter. I won't deny it. But we have some we think understanding as to why that was happening, and we didn't take that biggest step back. So at the end of March, where the market was kind of where we were in November. Even at the end of close yesterday, we were kind of back where we were in late August. So we'd stepped back, whatever that is, 7 months. And my point in saying it that way is, I suppose, again, adding a little perspective, if we weren't terribly concerned about where we were from a portfolio or financial plan perspective last August, coming out of like 2 great years in the market, we're in the same spot today. Now, I'll grant you, it feels a little different, and the bigger concern isn't so much where we are today, but where are we going to be 5 months or 6 months or 8 months or 10 months from now? I get that. But we are today essentially where we were 6 months ago. So if we weren't worried then, there's not a whole lot to be worried about now from a current state. I know there's still some things that we're worried about for the near future. I'm going to talk about that. But really, we're still in a pretty good spot, overall. Economic data is tough right now. If you look at like forward-looking 6 to 9 months, it's very, very difficult to have any of these speedometers green right now. The two that are in the red have stayed in the red for 2 years. By the way, I think equity market valuation might actually get back into the yellow over the next month. But you'll see, I think last quarter there were 7 green dials. A lot of these dials now moved back in the other direction, right? We see a lot that have moved from green back to yellow, as should be expected. When you're trying to project forward 6 to 9 months and you have a tariff package that gets rolled out, then paused. You don't know how much of that is real, how much of it is hyperbole, how much of it is negotiation tactic, what's going to get implemented. You have to be neutral. You can't be green. You really can't be red, because you don't really know what's going to happen. And so all of these indicators end up kind of in the middle, sort of I don't know, we'll see what happens. So a very, very neutral position right now on economic outlook, which is completely to be expected at this point. I know many of you are tired of hearing me talk about this or seeing the slide, but volatility is normal. Even at the end of the first quarter, we'd already experienced a -10 on the year, even though the quarter finished at a -5. At its worst, we were down about 15%, like 14.7 or something like that. As of yesterday's close, I think we're down about 10% on the year. But that volatility is normal. By the way, very normal where we're at right now. And what I mean by that is the average decline intra-year in the market, in the S&P 500, is 14%. So a 14.7% or whatever we were, a 15% decline. All we did was get to average. We had one average decline so far. Now, could it be more? It could. In fact, I probably expect it to be. But that's still, again, probably a bigger issue into the summer, unless we just get more emotional trading around these tariffs. But the I suppose takeaway here is, we've just gotten to average, but we've got to sit through all of that year in and year out, all that negative return that happens in the middle of the year, to capture all the positive stuff. And the positive stuff equals a little better than 10% per year. Year in, year out, on average, you're going to get a 10% return. But to get it, you got to sit through all this stuff. And I know you hate it. I hate it too. But there is no better way. There isn't. Believe me, if there was, we'd tell you. And if anyone ever figures out a better way to get all of the ups without sitting through all the downs, you will be the first to know. We will gladly share that news. But to this point, there is no better way to capture all the ups than to sit through all the downs, because the downs are temporary anyway. So we just have to take it on. And by the way, I don't want to forget to say this. We want the volatility. I know. No, we don't. Yeah, we do. And let me tell you why. This volatility, without volatility in the market, markets are safe. And if markets are safe, they go up in a straight line. If they go up in a straight line, they're T-bills. And what do you get in T-bills? 1.5%, 2%, because they're safe. The volatility is what demands the higher return. You only get the 10% return because your willingness to deal with, mentally and emotionally, you're willing to deal with the volatility. So without the volatility, without the risk, quote unquote, without that variability in return, you don't get 10%. You get 2%. And 2% doesn't stay ahead of inflation. It doesn't help you accomplish your goals. It doesn't let you retire the way you want to retire. You need a better return than 2%. We want the volatility. We need the volatility. Sounded like a few good men there. But we need this. And by the way, the volatility also works in our favor, especially when we're saving. When markets go down 25% or 14% in the middle of the year, or 38%, when markets go down and we keep investing, especially during our working timelines, we are taking advantage of the very good stocks that we've owned for 20 years, 30 years being on sale. We're buying, it's a 2-for-1 sale, right? We're buying more shares of the same great companies, but we're buying it again at a discount. So we love the volatility. It just doesn't feel good. It doesn't feel good in the moment. It doesn't feel good when you open your statement. The uncertainty of it feels horrible, and I get that. But really, we do want to a degree, celebrate it and accept it because it's how we get the returns that we're after. All right. I am not going to spend a ton of time on this like I usually do. PE is around 20. Again, PE ratios, for those who are new, price to earnings. So we're looking at the S&P 500. And in the S&P 500, there are 500 stocks. If on average, those 500 stocks have quarterly earnings of $1, I'll say if you average out all the earnings and they were $1, and then you look at all the prices of all the stocks, all 500 companies, and the prices on average were $20, that would be a 20-to-1 PE ratio, right? A 20 multiple on earnings. If earnings rose to $2, but prices stayed the same, that would be a 10-to-1, right? So that'd be a 10-time multiple, 2 to 20. That's PE ratio. On average, PE ratio is around 17 times earnings. Anytime prices get to 20 times earnings or above, which is about where we're at right now, we will say that stocks are expensive. Within one standard deviation, they're fairly priced. And when they get below 14 times, they're cheap. Stocks are not cheap right now. Right now, we're at about, if I saw the number correctly on Monday, I think we're at 18.5 times. At the end of the quarter, we were at 20 times. We aren't cheap, and unfortunately, we don't get cheap stocks very often. Right now, we're not cheap, but we're more fairly priced than we have been. And that's a positive. This has been an issue really for the last 2 years, where PE has been more than one standard deviation away from the norm. And so stocks have been expensive for a while now. It's nice to see them not, at least temporarily, not so expensive. And it's helpful as we continue to invest. It's helpful as we rebalance portfolios to be able to buy back into stocks at a lower price. I know that's of little, I don't know, of little comfort when your statement shows up, but volatility is normal and volatility is good. One of the other advantages of a lower PE is it gives us some more room for the stocks to grow over the year. Last quarter, when we noted that PE was around 23, you'll remember that our concern was it didn't leave us a lot of room for growth. On average, a PE at 23 means a year later we'll see no growth. And that's a factor in why we think this year is likely to be pretty flat point to point, January to December. It isn't flat, right? It's going to be very volatile. But point to point, we think it's going to be pretty flat this year. And this is a part of why. It's where PE ratios were at the beginning of the year. Now at 18, it does give us a little bit of room for growth over the next 12 months, which makes sense because the market's down. Even if it just rallies back to where we started, we're going to see some positive return over the next year from where we are today. So, but this is good. Again, a lower PE gives us a little bit more room for growth, and we like to see that. We also are seeing that the top 10 stocks have come down a bit right now. They're about 35% weighted in the S&P 500. So in other words, the other 490 stocks in the S&P 500 make up 65% of the weight of the market cap of the S&P 500. The top 10 stocks make up 35%. The problem with that is concentration. Those top 10 stocks can be bullies. And as those bullies decide to move, so too moves the rest of the market. And, that has been our concern. We'd really like to see this, closer to like 24, 25, 26%, because the top 10 stocks are always going to turn over. And so, you're always going to have some push on the entirety of the market based on how the top 10 are doing. But over these last couple of years, those top 10 stocks have taken over a much larger percentage of the market cap. And we'd like to see that come down. Even at 35%, it's still too high, but I'll take what I can get. 35% is better than the 40% we were seeing last quarter. So, small blessings, I suppose. A note on international stocks. International stocks have actually been doing exceptionally well the last 2 years. If I take NVIDIA, tells you how well NVIDIA has done. If I take NVIDIA out of the S&P 500 and look at the other 499 stocks, the S&P has actually underperformed Japan and Europe companies, Japanese and European companies, over the last 2 years. International sector has been doing very well over the last couple of years. In our portfolios, in our model portfolios, you may have seen that. In the fall of last year, we moved a little bit more into international. And by the way, we never have a ton in international. It's not like we have 30% of the portfolio in international. At any given time, we have around 10%. Last fall, we probably started at 8 and moved it up to 10. And here in the early spring, we bumped it maybe to 12. Again, it depends on which model you're in and how aggressive you are. But so it's not a huge move, but we're trying to take a little bit of advantage of the positive movement in international stocks, as well as the potential opportunity for those companies to do well under the new tariff plan, depending on how their countries react. And again, way too soon to tell what's going to come from that, but there's a potential for international to continue to do well. And so we want to have some exposure there. And it's been doing very well over the last couple of years. All right, let's talk about the economy. The economy is still doing well. Through the fourth quarter, GDP was up higher than expected. Last quarter, if you were with us, I expected this number to come in around 2%. It didn't. It came in at 2.5%. And that's pleasant to see. We don't think we're going to see that this quarter. We think it's going to be more like 1 to 1.5%, more in line with what we saw Q1 of last year. And there's a couple reasons for that. Most importantly, and by the way, this number will come out in about 2 weeks. But the reason that we're a little bit conservative here on our growth is that we're seeing inflation come down a bit. That gives us some indication that the economy is continuing to tighten a bit. And as it's tightening, we'll likely see some slower GDP numbers. But we don't think this is going to be negative. We're not heading into recession. There's really no economic data to point us towards recession. I could be wrong about anything, but I don't see, recession around the corner. We think if there's a likelihood of recession, it's probably pushed into 2026. At this point, we're just really not seeing anything. Not impossible, but it's very unlikely this year. I just saw, and I apologize, I saw that somebody kind of used an emoji to raise their hand. And in this session, I don't have any access to communicate. So if you do have a question, please send me an email, and I'll answer it offline for sure. I'd love to do that, actually. But this session, as we set it up, there's no way for us to communicate back and forth. So I apologize for that. But yeah, really, we're expecting still positive growth, and just a little bit tighter than it's been the last couple quarters. Delinquencies, this is one of those things that we watch. And if you've been with me before, we watch this pretty closely. The good news here is our auto and credit cards, our 30-day delinquencies, our late pays on auto loans and credit cards has really plateaued over the last 3 quarters. It's kind of been stuck at 8 to 9%. Not that I like it at 8 to 9%, but better than it continuing to increase. So we seem to be plateauing. Hopefully we start to see that moving in a better direction. The one we don't love right now is the trajectory of mortgage delinquencies. That's been on the rise. We're now at about 3.6%. Um, Again, not a big cause for concern because it's actually still pretty low, relatively speaking, historically, but at least over the last 20 plus years. Um, so it's not I don't know, a red light blinking or a red flag or something, but it is a concern at this point that we'll continue to keep an eye on. And if it continues to tick up, it might point towards some other things going on in the economy that we're not seeing right now. But as we sit here today, really pretty good data here. Home mortgage delinquencies are still relatively low. And more importantly, auto loans and credit cards have seemingly flatlined for the moment. All right. If you've been with me, you know I love this slide for the pure psychology of it. There's really no use for it other than the curiosity of it, I suppose. Here's what I mean. We are today consumer confidence in the stock market. We are today about where we were at the bottom of what's typically coined the Great Recession, November of 2008, when the market was down peak to trough 52%. Unemployment was as high as it's been in decades. And at that point, as we had very little confidence in the stock market. Today, after the market's been up nearly 50% for 2 years, over the last 2 years, we had one bad month. And after that one bad month, our polling data here would suggest we feel nearly as bad as we did at the bottom of the market in 08. And I just find that incredibly fascinating. I don't totally know what to attribute it to. And the only thing I think I can contribute or attribute it to is how prolific negative news media is today, how divided news media is today, and how many more inputs we have. And so with every negative turn, because remember, this is pre-tariff announcement even. So with every negative news announcement, we see or we feel worse and worse. And somehow over these last 2 decades, every bit of it makes us feel even worse. And that's the only thing I can attribute this to, because it's been a phenomenal 2 years. We had one bad month, and suddenly our confidence in the stock market falls apart. Now, I had a good question come up the other day, and I'm going to do some research on this. What goes into the fact set here? Is the polling just like 1,000 people in the Pacific Northwest that are tired of all the rain? I don't think that's the case, but I do want to do a little bit of work here. I'll come back to you next quarter with some answers. But I do just find the psychology of this very, very interesting. But nothing to do with it, other than I suppose, if you're at a barbecue this weekend and your neighbor says, boy, I feel lousy about the market, you can tell them they're in good company. So does everybody else. All right. But the rest of the economic data continues to be good. Unemployment numbers, still very low. Long-term average is about 6. We're at about 4. Now it's been slowly creeping up. It bottomed out around 3%. And here for the last really 2 years, every quarter it goes up like 0.1%. Last quarter it was 4%. Now it's 4.1, but historically still very, very low. Certainly, again, not pointing anything towards current recession or any scary data like that. The unemployment numbers are still pretty positive, as by the way, all jobs data is. The jobs report that came out a couple of weeks ago was fantastic. New job creation was good. Unemployment, underemployment, job losses, like all of the data was good. Labor supply numbers are good. There's a good number of job openings, but there's not a glut of openings. People aren't quitting. People aren't getting laid off. And there's no commentary here on the government layoffs earlier this year. But nationally, our layoffs are still very, very low. People aren't leaving their jobs. People who are losing their jobs or leaving their jobs still have a fair number of openings to turn to. And why do I harp on this? Because when people aren't quitting, that means they have jobs and they're getting paid. And when they're not getting laid off, that means they have jobs and they're getting paid. And when they're getting laid off or quitting their jobs and they can find more employment, then they're getting paid. And by getting paid, they can go out and spend their money. And when they spend their money, GDP looks great, right? Because the vast majority of GDP is driven by consumption. It's consumers going out with their paychecks and spending money. So we want this data to look as good as it does, and it does look good. So again, good economic data across the board through the end of the first quarter, including inflation. Again, a quarter ago, I was kind of negative on this. We were pretty concerned, and we were concerned because through September, October, November, December, these numbers were on the rise. They kind of bottomed out in August last year around 2.7% inflation year over year. Then they started to climb again, 2.8, 2.9, and got as high as 3.2. But in January, it went back down to 3. In February, it went back down to 2.8. March, we should have that number next week. And assuming that continues, it's very good news. And the reason it's good news is because it gives the Federal Reserve room to breathe, room to maneuver, some flexibility in what they choose to do with interest rates moving forward. If inflation keeps going up, the Fed doesn't have a lot of room to maneuver. They can't lower interest rates because that'll let inflation start to run rampant. That's 1970s stagflation problem. So you can't lower interest rates into a raising inflation environment. But if you can't lower interest rates and we find ourselves heading for some reason towards recession, tariffs or not, that you leave yourself no room. You can't kind of infuse cash into the system by lowering interest rates because you can't let inflation run rampant. With inflation coming down, the Fed has some room. And this is what we were worried about last quarter. And it's still a concern, but not nearly what it was a quarter ago. Because coming into this year, the market has been pricing in 4 interest rate reductions throughout the year, typically at a quarter point. So that means we're going to get to a 1% lower interest rate a year from today, Fed funds rate. Our concern coming into the year, given what was happening with inflation, was that the Fed might not lower rates at all. In fact, if inflation continued to go the same way it was going and the economy stayed as strong as it is, we thought there was an opportunity that the Fed might actually raise rates this year, a quarter point. We no longer see that as likely, especially if this trend continues. We don't even think we're at a 0. It's more likely, again, if this trend continues, that the Fed lowers interest rates, but we still don't see them getting to a full percentage point, more likely 0.5% for the year. Which is why we still believe over the summer, when this begins to materialize, that it becomes rather obvious that the Fed isn't going to lower interest rates 1%. We think that the market will react adversely to that. When it's expecting this and it gets this, that's going to probably lead to some summertime lulls, some doldrums over the summer. So if the market the S&P started around 6,000 points, we think it likely gets down somewhere around 5,000 points, 15 to 18% reduction before it rallies back towards the end of the year, back to around 6,000 points. So I keep saying kind of point to point, we think it's going to be a pretty flat year. But in the middle, we think there's going to be a pullback. Why do we think there'll be a rally at the end of the year? Because we think we'll start to gain some certainty both around the tariff package, but as importantly around the tax package. So the 2018 tax plan, many components of that expire here in 2025. So as it becomes clear what's going to be kept and what's not, we expect some clarity. Whether it's good or bad, again, almost doesn't matter. It's the certainty that helps. So as that stuff kind of clears up, we think there's going to be a year-end rally I'd love to be wrong about all this. I truly would. I don't want to be really wrong about the 1% because I don't want the Fed lowering interest rates more than they need to. Um, and as long as the economy is strong and inflation's heading in the right direction, I don't want to lower interest rates just because the market demands it. I think that's a pretty foolish move, and frankly, in a very good way, something that this Federal Reserve Committee has not been apt to do. They have kind of made their opinion and held it pretty firm. So they don't tend to capitulate to what's going on in the market. I think that's a healthy thing. So I don't really hope that I'm wrong, but I'd love to be wrong about the outcome. I'd love to, the market just doesn't care that interest rates don't go down as much as planned, and we get a little bit of volatility, and suddenly the year ends at 6,500. That'd be great. But kind of brace for impact here a little bit. We do think there's going to be uncertainty. And again, what am I trying to do here? I'm building our armor. I'm building our suit of armor. We're preparing for the certainty of uncertainty. All right, quick lesson on tariffs, and then I'll wrap us up here for the quarter. This is Nick Murray. He's a financial writer. We use him rather frequently. You've probably seen his name before if you've tuned into these, and you can read it. But tariffs are going to end up being whatever tariffs are going to be. The bigger they are, the worse they'll be for the economy, in my opinion, anyway. And I'll explain why I say that. But we can't control any of that. As I said earlier, we can only control how we react to it. And the thing I always take great comfort in is it almost doesn't matter, because the companies that we're invested in will find ways to adapt. And I made a mistake a minute ago. I was talking about, the market is expecting this, and the market will react poorly to that. The market doesn't do anything. The market isn't a living, breathing being. The market is just a place where we place trades, where we trade companies, right? So it's investors investing in the great companies in the U.S. and around the world. That's what we invest in. So I always take great comfort that those companies, which get up, by the way, the people who run those companies get up each and every day trying to find new ways to be more valuable and more profitable. That's what they're in business to do. And that's what we own, right? That's why we own them. It's actually very difficult to be a long-term successful investor if you don't have faith that in 5 years, 10 years, 20 years, the great companies you're invested in will have greater value than they do today. If you don't believe those companies are going to find a way to grow, it's really hard to be a successful investor. You have to have some faith mixed in with a little patience to let those companies figure out what's going on, adapt, and move forward. And they always do. The outcome isn't different. That's why we buy them. It's why we believe in them. And we will continue to do so. All right, little history lesson on tariffs. For those who know me, I love my history. Tariffs have been very, very low for the last 30 years, around 2%. For the last 7 years, there was a little bump in 2018 that we saw. The expectation of the tariff plan at the end of March was one thing. The tariff plan that was actually rolled out was another thing. And it's that difference that caused the widespread kind of crazy panic. Tariffs not that we haven't seen really since the Depression. But it was in part because not only were the tariffs high, but they were higher than even anticipated. And that difference causes anxiety and investors to make emotional decisions. And that's what we saw. That's what we saw the 10 days ago, 2 weeks ago, was emotional trading around an unexpected tariff bill. But this one only goes back to 1930. Now I'm going to go back even further. I'm going to go all the way back to 1790. And you can see here that we've had periods of time in our history for different reasons that tariffs have been much, much higher, 57, 47, 25%, albeit for the last, 50 years, they've been very low. But the first lesson I'll say here is you'll notice there was a steep decline right about here. And that steep decline happened for my history buffs, especially my constitutional history buffs. That was 1913. And in 1913, the U.S. passed the 16th Amendment, which gave Congress the ability to charge an income tax on its citizens. And at that point, we shifted from an economy that was run primarily by import tax to an economy that was run primarily by, well, not an economy, a government that was funded by income tax. So import tax to income tax. Now, by the way, for anyone who cares to know, that first income tax was 1%. It's a little higher than that today. But there was a shift. Now, with that shift, there's still this outlier right here, 25% tariff. That happened in the early 30s. That was the Smoot-Hawley Tariff Act. If you've ever seen I was trying to figure out a way to embed a video here. I'm not smart enough to figure that out yet. Maybe next time. But if you've ever seen the movie Ferris Bueller's Day Off, one of my favorites, in that movie, Ben Stein plays a high school teacher, history teacher. He's talking about the Smoot-Hawley Tariff Act during the Depression, and says something like, "Did it work? Anyone? Did it work? No, it did not work." And the U.S. sank further into the Depression. And this is the history lesson here. And take this for what it's worth. But I want to share it because a lot of what we were seeing in at that point in time will correlate to a lot of what we're hearing today. And for me, it's kind of always interesting to make sure we're learning from our history, right? So what was going on at the time was the Depression was starting and unemployment was rising. It had gotten to something like 6.3 or 6.5%, somewhere in that range. And Congress and the president at the time thought it would be a good idea to impose higher tariffs. By the way, we're only at that point 30 years removed from high tariffs, right? So let's impose some higher tariffs. And that'll serve two purposes. One, it'll generate more revenue for the government, which will allow us to maybe help our population. And two, by the way, does that sound familiar? More government revenue. But two, it will allow us to import, or it will force less imports. We will import fewer goods, which will force domestic manufacturing to ramp up. By forcing domestic manufacturing to ramp up, we'll need more people working. And so we'll solve the unemployment issue by having higher tariffs. Kind of a protectionist perspective. And in a bubble, that makes total sense. And probably would work. Except that it doesn't happen in a bubble. And it certainly didn't happen in a bubble in the 1930s. What happened instead was the Tariff Act was enacted. Yes, it had the effect of fewer imports, but the opposing countries did not sit idly by. They raised their tariffs, right? Creating a bit of a trade war. But now not only were we not importing as much, we were no longer exporting as much. And there was the unintended consequence, right? Because now we're not exporting as much. U.S. domestic companies have to adjust for that lack of revenue. when they have to adjust, because they will. Why will they? As I just got done saying, they will always find ways to be profitable. It's why they're in business. So now they have to find a way to be profitable. The first thing they're going to do, because it's the first thing that they always do, is cut their number one expense, which is their overhead related to people. It's payroll. And now the unintended consequence of trying to create more jobs was that there were fewer jobs available. Unemployment skyrockets to double digits, and we sink further into the Great Depression. That's why we don't like tariffs. It's not that tariffs are bad. It's that there are unintended consequences to raising prices. Now, if you're using tariffs for leverage, great. If you're using it to negotiate, fantastic. Can they be used for good? You bet they can. Can the economy absorb some tariffs? Absolutely. They're not all bad. But we can't get into a high tariff environment and think that it's not going to have a negative impact. It will. On some level, it will. Now, can we absorb, as I keep saying, some tariffs? You bet we can. Look what happened in 2018. Early 2018, new tariff package, primarily against imports from China. Everybody freaks out. Market goes down pretty significantly early in 2018 and again in December of 2018, all around trade. And yet, those tariffs are never repealed, even by the next administration as it came into power, despite the fact that that same administration said how terrible the tariffs were when they were being rolled out. They didn't then repeal them, right? So this is non-narrative. I'm not taking either side in this argument. I'm simply pointing out the, I suppose, the political hypocrisy there. Tariffs got absorbed. Market did well. Economy did well. It worked primarily, quite frankly, because tariffs didn't go up on the other side. It didn't. Our exports were not damaged by import tariffs. That might be different this time around. We will wait and see. But some tariffs can be absorbed. And it's hard to then eliminate them. It's hard to give up $100 billion in revenue to the government and repealing these tariffs. So it's once they're in place, they're hard to get rid of because you start to depend on the revenue. Last one here, just part of the history lesson. In 1860, 96% of government revenue came from tariffs. By 100 years later, 1960, only 2% of revenue came from tariffs, and that is the difference of income tax. And I think you can have one or the other, but I don't think you can have both. Meaning you can have high tariffs or you can have high income taxes. And I suppose whether or not income taxes are high is debatable. But you can have high income tax, you can have high tariffs, but I don't think you can have both. One has to give. And so that's part of this concern, because higher tariffs and higher income taxes lead to fewer dollars in consumers' pockets. And all the way back to that GDP number, if we're not spending, GDP gets pretty tight. So we want more dollars in consumers' pockets. And I will leave you then with this. I'd never done this before. If you were with me last quarter, I had the same slide up, and I don't usually do that two quarters in a row, put the same slide up, but I thought it was apropos this time around because of what we've experienced the last couple of weeks. I talked last time about the certainty of uncertainty. In the moment, any one of these things over the last 5 years feels different. And the great danger of the apocalypse du jour is that it feels different this time. And if you think it's different this time and act on it, you've made the great mistake. We don't want you to do that. But it's really, really hard because in the minute, in the moment, it feels different. And by the way, it is different. You know, in 2020, when the entire economy was shut down for a global pandemic, the likes of which we hadn't seen in 100 years, that was different. That was really different. and scary. But the outcome was the same. When inflation was going up near double digits and we had the worst year in the market for a moderate portfolio in nearly 100 years, that felt really, really different because it was different. We hadn't seen inflation like that in over 50 years. It was different, but the outcome wasn't different. When the banks were collapsing in March of 2023, just 2 years ago, that felt really different in the moment. It was different, but the outcome wasn't different. Companies adapt, the market recovers, and it begins again its permanent process of appreciation, punctuated by significant but always temporary downturns. And again, we want the volatility, and we're going to have to sit through it again and again and again and again and again. And every single time, it's going to feel different. And every single time, we're going to be nervous and scared and anxious. But the outcome, in my opinion, your eternal optimist, the outcome will always be the same. And I'll leave you then with this, because I'm going to kill you with statistics. On average, 1 out of every 5 years since the end of World War II, the market has gone down. We call that a bear market, right? We've had bear markets 1 out of every 5 years on average. When they happen for about 11 months. And in that time, I know it's hard to read this, but in that time, the market will go down about 30% on average. 30%. So what that means is roughly 1 out of every 5 years, the equity portion of your portfolio is going to lose about 1/3 of its value temporarily. And you got to be willing to sit through it, because to get all of the ups, we got to sit through all the downs. To get the 10.8% return per year, you got to sit through the downs. But be ready for them, because they're going to happen. I don't know when. I wish I did. If I knew when, this would be a different conversation. But I don't know when, as much as I wish we did. But I do know that they will happen. And when they happen, we've got to put on our suit of armor and let it all bounce off of us. I appreciate so much the time that you take to spend with me for an hour every quarter. I hope it's helpful. I hope it provides some perspective, especially right now. If you did have some questions, please send them my way. I'd love to answer them, or send them to your advisor. We'd love to help any way that we can. If you're new to this, welcome, and please reach out if we can help you in any way. We'd love to do that. If we can build your financial plan, we'd love to do that. Keep an eye out on May 13th. We're going to have a cybersecurity session. So that'll be a webinar, cybersecurity expert. So we're going to send out a link on that very shortly here. So keep an eye out if that has any interest to you. But again, thank you so very much for spending some time. I hope it was helpful. We'll see you again in a few months. And if there's anything we can do along the way, please don't hesitate to let us know. Have a great afternoon. Thanks.